This week, global markets delivered a series of rapid-fire developments. A steep new round of US-China tariffs, the first negative US GDP print in 3 years, standout big tech earnings, and wide swings in oil and gold. Let's unpack what actually happened, why it matters, and what could come next. Trade war developments. Early in the week, Washington announced an across-the-board 145% tariff rate on most Chinese imports, and Beijing responded with 125% levies on US goods. While trade doesn't grind to a halt overnight, these levels push many low-margin transactions into loss-making territory and force companies to rethink supply chains. One visible reaction was an import surge as firms rushed to beat the duty start date. That spike, along with other headwinds, helped tip first quarter US GDP to negative 0.3%, annualized. Economists caution the contraction wasn't driven only by import front-loading. Business investment eased and government spending cooled as well. Still, tariffs clearly played a role through the way imports enter the GDP formula. Despite the output dip, the labor market held up. April non-farm payrolls added 177,000 positions and unemployment stayed at 4.2%, suggesting businesses are cautious but not panicked. Midweek, China's Commerce Ministry confirmed it is evaluating a US proposal for renewed talks. Markets took even that tentative language as a sign the two sides might de-escalate. While a single headline can swing intraday prices, sustainable gains or losses depend on how negotiations evolve in the coming weeks. Key takeaway: trade policy is an important short-term catalyst, but the lasting effect on market value will be decided by the substance and timing of any deal. Big tech earnings. Amid the tariff noise, Microsoft and Meta posted results that beat even optimistic forecasts. Microsoft's Azure cloud revenue expanded 33%, boosted by new AI services. The stock gained about 10% in one session. Meta reported $42 billion in revenue and a 6% share price jump. Because these firms carry enormous index weight, their moves lifted the Nasdaq composite about 1.8% midweek and supported broad sentiment in Europe and Asia. Strong earnings don't erase macro risk, but they remind investors that companies with structural growth drivers can cushion a portfolio when headlines turn gloomy. Commodities in focus: oil. Brent crude slid towards $60 per barrel, a 6-month low. Analysts point to the combination of lukewarm demand signals from China and indications that Saudi Arabia may prioritize market share by easing output cuts. Weaker oil can relieve input costs for airlines and transport, but also hints at softer global growth expectations. Gold. Heightened tariff anxiety had propelled gold briefly above $3,500 an ounce. As dialogue prospects improved and US payrolls came in steady, gold gave back roughly 2%. Gold's pullback signals reduced immediate stress, but its price remains historically high, reflecting ongoing uncertainty. Copper. Often viewed as an industrial barometer, copper prices recovered roughly 1% late in the week on hopes a tariff détente would stabilize manufacturing demand. Commodity moves never map neatly to a single driver. Supply adjustments, currency shifts, and geopolitics all feed in. Still, the combination of softer oil and easing gold suggests the market's fear gauge ticked down a notch. Central bank responses. Federal Reserve, US, meeting, May 7th. Futures imply the policy rate will stay at 4.25 to 4.50%. Inflation has cooled, growth dipped, but jobs remain solid. The Fed can afford to watch data before deciding on cuts or hikes. European Central Bank cut its deposit rate to 2.25% on April 17th, the 7th easing in a year. President Lagarde cited weak exports partly linked to tariff uncertainty and signaled readiness to act again if necessary. Bank of Japan left its negative rate framework unchanged and trimmed its fiscal year 2025 growth outlook to 0.5%. Yen weakness is helping exporters but underscores Japan's sensitivity to trade flows. Monetary policy can soften credit conditions and calm markets. It cannot rebuild disrupted supply chains. Central banks remain supportive, yet their toolkit has limits. Investor playbook. Watch the negotiations. Financial markets will discount concrete progress or renewed escalation faster than the real economy can adjust. Prioritize quality balance sheets. Big tech outperformance shows that durable earnings streams provide ballast amid macro turbulence. Use commodities as context, not crystal balls. Oil and gold give clues about demand and risk appetite, but cross-check with currency moves, inventory data, and geopolitical news. Monitor central bank language. Guidance on growth and inflation will hint how far policymakers are willing to go to buffer shocks. Upcoming data points. May 7th, Fed decision and press conference. Any formal schedule for US-China tariff talks. Guidance from Apple and Amazon, released after Thursday's close. OPEC plus monthly compliance figures. Over 5 trading days we saw tariffs ratchet up, GDP tip negative, employment remained steady, tech earnings surprise, oil sag, and gold retreat. All reminding us that markets digest news in real time, but weigh fundamentals over months and years. Stay diversified, stay informed, and most of all, keep compounding.